Good afternoon, everyone. Thank you for joining us today. I'm Zach, the Outreach Coordinator at the Taxpayers Help Center, and I'm excited to be here to talk with you about the tax consequences of selling your primary residence. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two tax clinics, the first of which is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS. And the second of which is our volunteer income tax assistance, also known as VITA clinic, in which we help prepare income taxes for free. Additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. And then Zach, am the outreach coordinator here at the Taxpayers Help Center, and Masood Chotani is the clinic director. And before we get started, please, if you have any questions, feel free to use the chat feature to type in your question at any time. I'll be sure to address them. And then additionally, if you're watching this during a replay, if you have any questions at any time during the presentation, you can email us at info@taxpayershelpcenter.com and a tax professional will get back to you. Additionally, if you'd like to connect with us, you may do so at info@taxpayershelpcenter.com by email, Taxpayers Help Center Inc., a nonprofit organization, by Facebook. And then we have a location at 9029 Reseda Boulevard, Suite 209, Northridge, California. And then additionally, our website is taxpayershelpcenter.com, and you can reach us by the phone number listed here. Also, if you go on Google and you type in Taxpayers Help Center, all of this information is easy to find. The Taxpayers Help Center helps taxpayers both locally and beyond. And since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated, and those who can volunteer their time or expertise or spread awareness are also a great help. If you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or you can go to taxpayershelpcenter.com and click on the Make a Donation tab, which I have highlighted in red here on this image. So today during our presentation, we're going to discuss tax consequences of selling your primary residence, and we'll address the following topics. First, we're going to answer the question, does your home qualify for a partial exclusion of gain? Then figuring gain or loss, property used for business or rental, how much is taxable, reporting your home sale, and then lastly, how to get tax help. So first off, we're going to answer the question, does your home sale qualify for the exclusion of gain? The first thing you need to know is the ownership and use test. This is a pretty straightforward requirement. You must have owned and lived in the home as your primary residence for at least 2 years out of the last 5 years before you sell it. These 2 years don't have to be consecutive. You can spread them out over the 5-year period. For instance, if you have owned the home for 4 years but rented it out for 2 of those years, you could still qualify if you lived in it for any 2 of those 4 years. Now let's talk about the money part. The exclusion allows you to exclude up to $250,000 of the gain from your income if you're single. If you're married and filing jointly, that amount doubles to $500,000. This is a huge benefit, especially if your home has significantly appreciated in value. Essentially, this exclusion can save you a lot of money on taxes when you sell your home. And here's something important to keep in mind. The exclusion isn't something you can use over and over again without limits. There's a frequency limit in place. You have used this exclusion on the sale of another home in the last 2 years. This rule makes sure that the exclusion is being used for genuine home sales rather than a way to avoid taxes repeatedly. And finally, there are some special situations where you may still qualify for a partial exclusion even if you don't meet all the requirements. So for example, if you had to sell your home because of a job change, health reasons, or an unforeseen event like a natural disaster, you could still be eligible for a prorated exclusion. These exceptions are designed to give you a break if life throws a curveball at you and you're forced to sell your home under difficult circumstances. So next we're going to talk about the question, does your home qualify for a partial exclusion of gain? So if you don't meet the full eligibility test for the home sale exclusion, you may still qualify for a partial exclusion of gain. This is essentially a reduced version of the full exclusion and is available under certain circumstances. It's a way to provide some tax relief even if you had to sell your home sooner than expected. Let's talk about the situation where a partial exclusion may apply. The most common scenarios include a change in employment that requires you to move so first off, a change in employment that requires you to move, any health issues that make it necessary to relocate, or an unforeseen event, as we mentioned before, like a natural disaster that would force you to sell. So these circumstances are considered valid reasons for selling your home earlier than planned, and the IRS offers some flexibility here. So how is this partial exclusion calculated? It's based on the amount of times you lived and owned, you owned and lived in the home relative to the full 2-year requirement. So essentially you take the fraction of the 2-year period that you did meet and apply that fraction to the full exclusion amount. So for example, if you only met 1 year of the 2-year agreement, or of the 2-year requirement rather, you might be eligible for half of the exclusion, which is $125,000 if you're single, or $250,000 if you're married. So let me give you a quick example. Suppose you owned and lived in your own home for 1 year before you had to sell due to a job relocation. Since you met 50% of the 2-year requirement, you would qualify for 50% of the full exclusion. So if you're single, that would mean up to $125,000 of your gain could be excluded from income. This calculation helps you still get some of the tax benefits, even if you couldn't stay in the home for the full period. When you sell your home, figuring out whether you have a gain or a loss is all about the numbers. The basic idea is to compare the amount you sold the home for with your adjusted basis in the property. If the selling price is higher than your adjusted basis, you have a gain. If it's lower, you have a loss. This calculation is key because it determines whether you might owe taxes or if you can deduct a loss on your taxes. Now let's break down what we mean by adjusted basis. Your adjusted basis starts with the original purchase price of your home. To that, you'll add any significant improvements you made over the years, such as adding a new roof, remodeling the kitchen, or building an extension. These kinds of improvements add value to the home and therefore increase your basis. You'll add certain expenses related to the purchase, like closing costs, but if you use your home for business or rented it out at any point, you will need to subtract any depreciation you claimed during that time. This adjusted basis is what you'll compare to the sale price to figure your gain or loss. So now let's talk about calculating your gain. So to calculate your gain, you start with the sale price. This is not just the cash you received, but also includes any other property or services you may have received as part of the sale. For instance, if the buyer threw in a car as part of the deal, you'd include the value of that car in your sales price. Next, you subtract your adjusted basis from that sales price. So this step gives you your gain. If your adjusted basis is lower than the sale price, that difference is your gain, and that's what you'll be working with when figuring out any potential taxes. Let's look at an example. Suppose your home sold for $400,000 and your adjusted basis in the home is $300,000. You can subtract $300,000 from $400,000, which gives you a gain of $100,000. This $100,000 is the amount you'll need to consider for tax purposes, and depending on your situation, some or all of it may be excluded from your taxable income. So now let's talk about calculating your loss rather. So on the flip side, if your adjusted basis is higher than the sale price, if you got a loss. This can happen if the real estate market drops or if you've put more into the home than what you can recover when selling. Unfortunately, if your home was your primary residence, you generally cannot deduct a loss on your taxes. The IRS doesn't allow personal losses to be deducted. However, if the home was used for business or rented out, part of the loss may be deductible against other income. So here's an example. Say you sold your home for $250,000, but your adjusted basis is $270,000. You'd subtract the $250,000 sale price from your $270,000 adjusted basis, leaving you with a $20,000 loss. While this loss reflects a financial setback, it's not something you can typically deduct unless the home is used in a business or rental capacity. So these slides and notes should help break down the complex topic of figuring gain or loss on the sale of a home into manageable pieces. So if you've used part of your home for business or rental purposes, things get a bit more complicated when it comes to taxes. When you sell a property that's been used partly for business or rental, you have to handle the gain or loss differently compared to a purely personal residence. The IRS considers the business or rental portion of the home as a separate asset, and that can impact how much of your gain rather is taxable. To figure out how much of the gain or loss is related to the business or rental portion, you will need to allocate the total gain or loss between personal use and business use. This is usually done based on the percentage of the home that was used for business or rental. So for example, if you use 20% of your home as a home office, then 20% of the gain or loss from the sale is considered business related, and the rest is personal. So here's a key point. If you've claimed depreciation on the business or rental portion of your home, you need to recapture that depreciation when you sell. This means that the depreciation you've claimed over the years will be taxed as ordinary income rather than being excluded or taxed at the lower capital gains rate. This recapture can have a significant impact on your tax bill, so it's important to plan for it. Let's go through an example to make this a little bit clearer. So suppose you've been using 25% of your home as a dedicated home office for the last few years, and now you're selling the property. You sold the home for $500,000, and your adjusted basis in the home is $300,000. Normally, you would have a gain of $200,000, but since part of the home is used for business, we need to break it down. First, we allocate the gain between personal and business use. So since 25% of the home was used for business, 25% of the $200,000 gain. So $50,000 will be treated as a business gain, and the remaining $150,000 is personal gain. And you may be able to exclude that under the home sale exclusion rules. But we're not done yet. Next, we need to consider depreciation recapture. Let's say you've claimed $20,000 in depreciation on the home office over the years. This $20,000 will be taxed as ordinary income, not as a capital gain because of the recapture rule. So in this example, the $150,000 personal gain may be excluded from your income if you qualify for the home sale exclusion. However, the $50,000 business gain is fully taxable, and a $20,000 depreciation recapture will be taxed as ordinary income. This mixed-use scenario often leads to a higher tax bill than if properties were used solely as a personal residence. So it's crucial to be aware of how these rules apply. When you sell your home, the first step in reporting the gain or loss is filling out the Form 8949. This form is where you'll list the details of the sale, including the sale price, your adjusted basis, and any expenses of the sale. It's important to complete this form accurately as it's the basis for calculating your gain or loss. After you've filled out Form 8949, you will transfer the information to Schedule D, which is where you will calculate your overall capital gains and losses for the year. If you have a gain, it gets added to any other capital gains you have, and if you have a loss, it can offset other gains or potentially reduce your taxable income. If you qualify to exclude some or all of your gain under this home sale exclusion rules, you will still need to report the sale on Form 8949 and Schedule D. However, you will only include the taxable portion of this gain, if any. This is crucial because it ensures that the IRS knows you've sold your home even if you don't owe taxes on the gain. When it comes to reporting deductions related to your home sale, the first thing to know is that you can deduct certain selling expenses. So these include real estate commissions, legal fees, advertising costs, and any other expenses directly related to the sale of the home. These deductions are subtracted from your sale price, which reduces your gain and consequently your taxable income. Another important aspect is capital improvements. Any major improvements you made to your home, like adding a new roof, renovating a kitchen, or installing central air conditioning, can be added to your adjusted basis. This increases your basis and reduces your taxable gain, so it's crucial to keep good records of these improvements. If you itemize deductions on your tax return, you may be able to report some costs associated with selling your home on Schedule A. This includes things like mortgage interest and property taxes that you paid up to the date of the sale. It's a good way to potentially reduce your taxable income further, but remember, only the portion of these expenses that aren't reimbursed or paid by the buyer can be deducted. Sometimes a home sale doesn't go through, and the buyer forfeits their earnest money deposit rather. If that happens, you'll need to let me start again. If this happens, you will need to report that forfeited money as income. It's considered taxable income by the IRS, so make sure to include it on the tax return. Another scenario is if you sell your home but then rent it back from the buyer for a period of time before moving out. Any rent you paid to the buyer is their income, but it's important to know that if you receive any payments during this period, those would be considered taxable rental income and should be reported on your return. And don't forget about other types of income related to the sale. For example, if you provided seller financing and are receiving interest payments, that interest is taxable and should be reported as income. Any other proceeds from the sale that aren't directly part of the sale price rather, should also be reported. If you claimed the first-time homebuyer credit when you bought your house and are now selling it within 36 months, you may be required to pay back some or all of that credit. Their payment is generally handled rather by adding the credit amount to your tax bill for the year in which you sell the home. This can be a big surprise if you're not expecting it, so it's important to be aware of the rule. Similarly, if you claimed any energy-related credits, like for installing solar panels or energy-efficient windows, you may need to recapture some of those credits if you sell the home within a certain period. The recapture amount typically reduces your gain, but it's still something you need to report. For those repaying the first-time homebuyer credit, you will need to fill out IRS Form 5405. This form is where you calculate the amount you need to repay and add it to your tax return. It's crucial to include this to avoid any issues with your tax filing. If you need help with your taxes, the IRS website, irs.gov, is a great place to start. You can find all the forms and publications you need, as well as tools like the interactive tax assistance, which can help answer your tax questions based on your specific situation. There's also the Where's My Refund tool if you're checking on your refund status, and plenty of other resources to guide you through the process. And for more personalized help, you may want to consider hiring a tax professional. CPAs, tax attorneys, and enrolled agents are all qualified to provide expert advice tailored to your situation. They can help you with everything from filing your return to representing you in case of an audit or dispute with the IRS. Hiring a professional can be especially valuable if your tax situation is complex. If you're looking for free help, there are also great options available. Programs like VITA, which is a clinic that we run here at the Taxpayers Help Center, and TCE, Tax Counseling for the Elderly, offers free tax help to qualifying individuals, especially with those with low to moderate incomes, seniors, and people with disabilities. Volunteers are IRS certified and can help you prepare and file your tax return, ensuring you get all the credits and deductions you are entitled to. So let's quickly recap the key points from today's presentation on selling your primary residence. So if your sale qualifies, you can exclude up to $250,000 of gain if you're single, or $500,000 if you were married filing jointly. Remember, you need to meet the ownership use and frequency tests to qualify. But even if you don't meet all the tests, you may still qualify for a partial exclusion in cases like job relocation, health reasons, or unforeseen circumstances. And to determine your gain or loss, subtract your home's adjusted basis from the sale price. The adjusted basis includes your purchase price plus any improvements minus any depreciation. Any gain that exceeds the exclusion limits or gain from non-qualifying portions of your taxable property will be taxable. And then to report the sale, use Form 8949 and Schedule D if necessary, and make sure to keep thorough records of all the sale-related documents and calculations. And then lastly, if you're unsure about any aspect, it's wise to consult a tax professional or use IRS resources for guidance. So with that, that's everything. And again, thank you for joining us. And since our services are free, donations are crucial for our support and expanding our reach. So monetary donations are greatly appreciated. Additionally, those who can volunteer their time, expertise, or help spread awareness are a great help. So if you have had any questions about anything during the presentation, please email us at info@taxpayershelpcenter.com, and your questions will be addressed and answered by a tax professional. And so with that being said, thank you all for listening and have a great day.